This is Annuity Straight Talk. Since 2008, your host, Bryan Anderson, has helped clients nationwide navigate the complex market for annuities. With Bryan's assistance, hundreds of clients have achieved a profitable and secure retirement. I would know, because Bryan has answered many of my questions concerning annuities and retirement planning. So that you can benefit as well, let's get started. Here's Bryan.
Hello and welcome everyone to the Annuity Straight Talk podcast, episode number 42. My name is Bryan Anderson, founder and creator of Annuity Straight Talk, author and media personality, all of that combined. It's me. This is my website, and I'm the one giving the information. So, episode number 42, why I don't sell variable annuities. I'm coming to you from Northwest Montana. A decent spring day. Been pretty cool this year. I was supposed to get some sunshine, but the clouds moved in. Montana, I think people say this about a lot of states. If you don't like the weather, wait 15 minutes, it'll change. So it looks like clouds are still all to the west. So we might be stuck with this for a while. Over the years, I've had a lot of questions about annuities and retirement planning and all this stuff. And so I wanted to address the topic of variable annuities again. The reason for that is, I get a lot of requests from people that are looking at all sorts of different products, and sometimes people come to me and say, "Hey, what do you think of this variable annuity?" Now, a lot of people think I don't have a lot of information about variable annuities on the website, which is not the case. I just don't sell them because I don't think, I guess I'm providing an alternative to that. Now, variable annuities are by far the most popular annuity product on the market. They account for about 60% of sales. So somewhere in the $125 to $150 billion a year is sold in variable annuities. And there's a specific reason for that. Educated guess, assumptions, and ideas, and just being in this business for almost 20 years is kind of where I come up with that. So, but I guess it's interesting to me that, people will ask about it. I think more rarely than they want to, because they don't think that I know about it. I don't talk about it all the time, but here it is. And I guess the best way to do it is to share my screen with you, and I'll show you what I do have on the topic. Now, I had to put a lot of research into this one. And the reason for doing that, or the reason I had to put a lot of research into it, is because I wanted to, it's not because I didn't know, but I wanted to kind of organize my thoughts a little bit and make sure that I said what I needed to say. So I'm going to take you to the newsletter page, and we'll go get started. And this is how you do it, right? So in the search box, I typed in variable annuity. This is the website. I typed in variable, simple as possible, get the widest range of results. If I did variable annuity, it may not match perfectly, all that stuff. But here you go. So variable, and I hit enter, and here are my search results. And so you can see right on the top, in the past year, I've done 3 articles, 3 newsletters, and a podcast about variable annuities. And so I want to talk to you about that, and I'll start from the beginning, which is, I guess when I mention this, now variable annuities are what got me into, or kind of piqued my interest into the idea or the topic of retirement planning. And anybody who's followed this for a while, you may know about it a little over a year ago, maybe a year and a half. I did a series of newsletters on, how I learned about annuities, my evolution of annuity thought, and how I kind of figured some of these things out. Well, when I first started selling annuities, I was just selling fixed annuities because they had really nice fixed rates for, I don't know, the first one I sold was to a widow about 65, and she just, wanted something better than a CD and wanted some tax deferral. And, we got her 6% when the best CD was 3.5. things like that. So it was simple, just improving rates. And that's kind of what piqued my interest because, I got paid to do it. And I was like, oh, okay, this is interesting. Maybe here's another, so I branched out and I did a lot of stuff. And then when variable annuities came, I worked with, early in my career or beginning of my career, I worked with Guardian Life, and they came out with a really, really good variable annuity, and they still have it. And it's a fantastic company, but, the variable annuity was, one of those guaranteed lifetime withdrawal benefits. And no matter what happens, you're guaranteed income for life on the variable. So, that's kind of where I started looking at it. And because of how, I was taught in the business, I entered the business with an insurance-based approach to accumulation toward retirement, not in retirement. But it kind of like the strategies they used, and it was all about tax reduction, volatility reduction. Some of those things just kind of really taught me to think outside the box. So when the variable annuity came in, I remember, the old guys in the office, the guys I learned from, they were really excited about, oh, this is great. This would be a great way. Anybody that's got a 401k, we'll just put them into this thing and that. And it was kind of like it was a quick sales idea is all it was. But because of how I had learned to think outside the box, I started kind of crunching the numbers. And I've gone into this in other podcasts or newsletters. And so I'm not going to touch on it a ton right now, but that's what really got me thinking about how do you best maximize your potential, your output, and all the, maximize the benefits in retirement essentially. But that's where I was first introduced to variable annuities in probably 2006. And so when I started this website, it was kind of, it was partway through that evolution where I wasn't focused on variable annuities because I had a different plan. Now, I'm not trying to say that variable annuities are bad, but there's a reason why they're sold, in my opinion, and it's a pretty fair, it's a verifiable opinion. It's not really hard. It's no great stretch of the imagination to understand why that would happen. But I wanted to be an alternative to that. So I'm not just out there selling stuff. I have ideas. I have strategies. I have proven stuff. I have really, really good analysis behind a lot of the stuff I do. And it fits for certain people. Maybe not for you. So I'm not trying to say don't buy a variable annuity. I'm just saying this is why I don't sell them. So I started with this. I remember, and because obviously I work in a business where we advertise in certain areas, and all of you came to this website because you hit some advertisement, something you were searching for. I had an explanation for it or my opinion on that, and you found an ad, you showed up here, right? And I thought, well, if 60% of people that buy annuities are buying variable annuities, maybe I should just write this guide to explain the product. Because a lot of people were calling and asking about them, like, hey, what do you think about this or that? So the simple guide to variable annuities goes kind of through all the features, options, the benefits, all the things that you can do with a variable annuity. And it kind of starts with why are they the most popular products? And the reason is that if you do a search for, like you say, like a lot of research on this, and where do I do research? I go to my website. I go to the newsletter. I search variable. If you want to research variable annuities, go there, start there. It's simple and easy. But if you search for variable annuities, you're going to see Ken Fisher is going to put an ad on the top saying, stay away from annuities. They're bad. And here's my book. You should read it. That's what Ken Fisher does. The ones below that are, it's Fidelity. It's Raymond James, Edward Jones, like the big brokerage companies will sell variable annuities and not anything else, but they're all sales related, right? I want to provide information so people can do research and people can understand topics. And so I think probably based on the first page of results from Google that I looked at, my website's probably the best place to learn a little bit about a lot of basic stuff about variable annuity. So in the simple guide, I looked at it and you realize that you got Ken Fisher telling you not to buy an annuity. You got Fidelity saying, hey, if you want to buy one, we got the great annuities and all this stuff. The reason why they're 60% of the market is because people are buying them from an investment manager they have already. So you realize that prior to 2020, like the pandemic, there was an index annuity. I've wrote about it a lot. We're not going to talk about that, but there was an index annuity, and there was a couple of them. I think index annuities are probably 3 of the top 5 most sold products in the country, like individual products. Now, variable annuities still had all that stuff, or variable annuities still accounted for the majority of sales, but no single variable annuity was the most popular. And it's an interesting distinction, but the reason why they became popular again in 2020, and why the variable annuity shot to the top of product recommendations, and I think it was Jackson National, great company. They have a really competitive variable annuity. But in 2020, when the pandemic came, the market took a dive, and so that's where what happens is you got an investment manager, and those big companies, the big brokerage companies, manage the majority of retirement assets, the vast majority, probably 70-80% of assets. Well, if you go into your investment manager and you say, I'm nervous about where the market is, and I'm retiring in a few years, and I want to take some risk off, he's going to say, oh, variable annuity, because the variable annuity you get to guarantee income on top of it, regardless of what the market does. So that's one of the features of the annuity, right? So that's the quick, easy answer for an investment manager who wants to reduce risk in a client's portfolio, saying, oh, let's peel off this portion of it and give you guaranteed income no matter what happens. And they do that because now there are lots of different ways to reduce risk in a portfolio, some without fees, but they have that answer because they get to keep the assets under management. It's within their book. And they don't have to see if they sold an index annuity or a fixed annuity. Those assets are going to leave their management, and they're basically going to lose part of their book, and they don't like to do that. So, and I think that's really interesting because it's like, that's where, a lot of those guys are fiduciaries and they're supposed to act in their client's best interest. And there's lots of times when variable annuities do solve the problem, but that's essentially what they're doing is they're trying to maintain assets or collect more assets that they can put on their book as managed. So that's kind of why, because if they're controlling 70 or 80% of retirement assets, most people are working with a big brokerage company, then most people that buy annuities are probably going to buy the annuities that a big brokerage company sells. Makes sense. Now, those guys will have like 1 or 2 options, or they'll have a couple of things. They're not brokers. They don't represent the entire market. But because I'm not in that business and I feel like I have a better way of doing things, that's why I don't sell annuities or sell variable annuities. So in the guide, we talk about all the different features you can have. You can have guarantee. So you've got market participation in a variable annuities. Essentially, it's an annuity contract where your assets are invested in market-based, mutual funds, bond funds, stuff like that. And so probably no individual stocks, but you're essentially invested in the market, but you get the tax shelter of the annuity. And when I went through this, I just talked about the traditional purpose of it. Obviously, I'm going to touch on that a little bit later with one of the other letters. And then it's all about the additional fees for the contract. So you buy a variable annuity and you got an M&E fee, a mortality and expense fee, which means if you put $100,000 into it and the market corrects 50%, it's a death benefit that guarantees your initial principal regardless of what the market does. So that's the base contract fee for variable annuities. In addition, you can get a guaranteed income rider that says, no matter what the market does, we're going to guarantee this income payout for the rest of your life. That costs an extra fee. So you got your mortality and expense of 1%. You got an income rider fee of 1%. There's also a fund fee, like the mutual funds have a management fee. Let's call those 0.5%. So you get the M&E plus the income and the fund management fee. You're at 2.5% with all of that. Now it'll go quite a bit higher. You also have additional death benefits that you can put on it, which would say, so the M&E fee covers your initial investment. It's guaranteed to go to your heirs, less any withdrawals you make. So if you start taking income, that M&E benefit goes down over time fluctuates with the market, but it goes down as you pull money out. But if you add an additional death benefit, you can still take money out of it and still pass your remainder on to your heirs. It's a really good deal if you want the benefit. Okay, so all of those things, it's a benefit matching plan. If you want the benefit, pay the fee. So if I think I figured it out, and you take the Jackson product and you go everything, you got the M&E and you got fund management, which their funds, some of them were pretty expensive. I think it was 1.5 was the average. So the M&E with the fund management 1.5, 2.5, plus the income rider was 3.5, and then you can get the enhanced death benefit on it. And what that essentially means, that's another 1%. So you're at 4.5%, maybe 5%, depending on what you do. You're paying 5% in an annuity contract, but what you get is you get your investment, you get guaranteed income, you get continued market participation, you get a guarantee that no matter what happens in the market, your family or your heirs will inherit no less than the initial amount. That may be expensive, but that type of opportunity is extremely valuable. Now go into a broker's office and say, this is what I want. I want a guaranteed, I want to invest in the market. I want guaranteed income, guaranteed. And I want to make sure that my family inherits all of this money, no matter what happens when I die. And if they don't laugh you out of the office, they're going to say, oh, okay, cool. Here's the Jackson National Variable Annuity. We'll sell it to you, right? That's what it's for people who want to mitigate risk, but you got to pay to do it. So I think there's a better way to properly structure a portfolio to put all of those goals well within reach under reasonable conservative assumptions. I think there's a better way to do it. That's why I don't sell variable annuities, because you're going to look at the 4 to 5% fee for all that stuff on there and say, yikes, I don't want to do that. Well, if you wanted to do that, you got to explore different opportunities. So I'm not here to say that's a bad deal. If that's what you want, go do it. But if you want a different way and you want a different approach, that's what I do. So I'm not trying to sell something to everyone. I'm just offering an alternative to those people who don't want the other offer. Pretty simple to me, honestly. So now in addition to that, so I go back to my search results and when variable annuities work. I'm not sure what happened to the picture that I put in there. Sorry about that. I'll fix it. So there are so I wrote this because there are a couple of instances where a variable annuity is the best option. Now this goes into the traditional purpose of variable annuities. And the traditional purpose was a tax shelter. So you get deferral of taxes. Now we're talking like in this situation where you're talking about tax deferral, typically it's for people of high net worth, really high income, where they've maxed 401ks, IRAs. They have no other tax deductible savings plans, and they want to defer taxes. Now, if you're in a 35-40% tax bracket, federal, state, could go even higher. I think the highest in California for the high net worth is 50%. New York's similar. But if you don't have any other way to save that's tax deferred because you've maxed out everything else, then a variable annuity is a good option, because if you think about just the base like a gutted contract that has nothing but M&E and a bunch of fund options, then you're going to pay 1% mortality and expense fee, and that could be and likely would be for a high net worth individual far less than paying taxes on dividends, short-term capital gains for funds that buy and sell stocks throughout the year. So in a lot of ways, it was a tax play for wealthy individuals to do it. And that's one of the core advantages of variable annuities, non-qualified funds. Now, they've been used in every other type of funds as well because of the additional benefits. And I think the additional benefits can be done elsewhere. But when it works is for tax deferral when there's no other way to defer taxes on market-based investments. So the next option is, and I remember this is a story from early in my career where one of my mentors had a 80-something-year-old lady who came in and, had this nice chunk of money and wanted to make sure she kind of wanted to be in the market, but she was nervous about it. And she said, the goal for this is to make sure that my kids get all of this money. She had all of her insurance in place and plenty of income and other assets and all this stuff. So this is a piece of her portfolio. And he put her into a variable annuity. And I kind of scratched my head. I was young. I was kind of like, why'd you do that? Well, that's when I learned, that was early in the career. I learned, oh, wow. So she's basically on a mortality and expense fee where she can put the money in and she's paying the M&E. And no matter what happens in the market, her kids will inherit everything she put into it. Even if the market drops 50%, she croaks the next day, they're still going to get the principal back. But she's got the death benefit protection on market upside in the portfolio. So she's going to get a tremendous amount of growth. There are also options where you can add more coverage on the death benefit by locking in the high water mark. So for instance, you put 100,000 in and it moves up to 150, you lock in that high water mark and then it drops to 120. Your death benefit would be the high water mark, the highest point the contract reached. So tax deferral and death benefit protection on market-based investments is one of the core values of a variable annuity. I don't run into those situations often enough for it to be a big part of my business, so that's why I don't sell variable annuities. I know some people that do if you really want one. So, next on the list of newsletters, now I've got, I had a whole bunch of calls over the years on what should I do with this variable annuity. Now, in 2010, 12, 13, 14, people would call me, their variable annuities were underwater, which means they lost money, and the income benefit was substantial enough that was the best thing about the contract. I said, you got to keep it. You got to keep it, right? Now, in the last couple of years, the market was really high, and people were calling me saying, well, it was underwater for a while, and I've had this thing for, say, 15 years. A lot of people, I talked to a guy last week that I'm emailing with. He's had one for 30 years, and somebody's trying to sell him out of it. Might talk about that bit later. But anyway, people come up with, these things. It's like, well, we've been nervous about this, but it really bounced back and it grew really well. And here it is. Now, variable annuities have done well over the past 30 years because the market, and in 30 years, there's only, 5 negative years, maybe 6. The rest of them have been substantial upside, a lot of growth in the stock market. So the variable annuity offers certain types of protection if you want to invest in the stock market. So, maybe I'm too rosy about the variable annuity. Maybe people are going to want to start buying them, and that's fine if that's what you want. But it's still, I'm not going to get into that game. So, but people would call and say, I've got this thing. What should I do with it? And it's going to depend on your situation. So, in the first case study, I essentially talked about, a couple that had a variable annuity. Of their total portfolio, their spending needs were 6%, which I think is reasonable, later in life in your 70s, and, the husband is 80 years old. So I think 6% is attainable. In my opinion, you got to structure a portfolio just right to do it. But they were thinking about, like, their annuity was $472,000, which is right here. Guaranteed lifetime income was $20,000 per year. It was really, really weak. It was less than 4%, which I don't understand because they'd had that for a while, but they just bought a contract that had a weak guarantee. So with them, I suggested they do something else. They can annuitize the account value, which is, so if they took the $20,000 per year, the $20,000 would come out of their $472 balance, minus the fee, also with market volatility up and down, all that stuff. If they annuitize it, they commute the cash value for a guaranteed lifetime income payment, and that was $30,000 a year. Because $30,000 is more than 6% of 472, that got them over their income goal for those assets, which means it would take a lot of pressure off of the rest of their portfolio. They'd have more flexibility over it. So I recommended they annuitize it. So they keep the contract, but use it in a different way. I didn't make money selling it. I just do the numbers and tell them what's best for them. Now, I had an advisor commented on this post. He's at the bottom. You can look at it. And he said, I disagree. I don't think you should ever do that, right? And I'll argue it a bunch of different ways. And it probably, like, man, I'm not going to do a podcast on it. I could go into, finite details about why that's probably the best thing, because I ran it over various tons of different historical scenarios, and annuitizing always popped up. But he didn't think it was right to eliminate that cash value. The kicker in this one, which I didn't explain, is this couple had extreme longevity in their family. They expected to live to their mid-90s. To have all of their assets in the market without a solid guarantee was too much of a risk for them. Now, I don't know what they did. I don't know if they took my advice. I know they went to a local broker, and I hope they got good advice to do it. I'm afraid they're very nice people. I really enjoyed speaking with them. But I'm worried maybe they went into, market-based investments and lost, 10, 15% recently, which would make their situation much harder to deal with. So anyway, but that's one interesting. Take the contract, keep it, or keep your contract and do something different than you had planned. That's an option. Case study 2 is a guy that we did business with in the past in different areas. He came out, he actually sent me in the mail, he sent me his variable annuity statements. Hey, what should I do with this? Highly appreciated. And that's one of the issues. A lot of these things, if they're non-qualified, they're highly appreciated. You can't, well, I guess in the third case study, I'll tell you a little bit more about that. But he was getting, $44,000 a year, and he didn't need the money, but he was spending it. So it's kind of a discretionary issue for him. He's like, well, should I protect this value? And when I discovered that he is actually spending the money, it's not like he's just taking it and saving it. If he was, it'd be different, but he's spending the money, and he had a really solid contract value. It was a great company. And I told him, you keep it, because I took it. And if I could take the money and produce higher income for him, then we would have had a play. But his income benefit was very healthy. It was written in the past when rates were good. That guy keeps the contract. Like, keep it doing the same thing you're doing it. Don't worry about it. You're good to go. So I think he certainly appreciated that. I would have loved to make that sale, but there was not a viable reason for him to get out of it. So there's one person, like, keep the contract you have and live with it, because it's pretty dang good. Number 3 is a guy that I've talked to for a long time and never done business with. He called me about this time last year. Hey, listen, I've got this variable annuity. I think it was like it was a big contract, 700,000, but he had it for, 20 plus years, and about 80% of it was gain in the contract. So he wanted to, this is a part of his portfolio, and everything was in the market. He'd made a lot of money since I started talking to him. His net worth has almost tripled since I started talking to this guy. And he said, well, I'm wondering if I should decrease risk. Now, he's got the death benefit of that account value, and I'm not sure if it's a high watermark death benefit or just a principal death benefit. I don't know that, but in this case, I looked at it, and because he was 90% invested in the stock market, he's 75 years old. If he wants to protect some money, he certainly could transfer that to another contract, because it's highly appreciated and there'd be a huge tax hit for taking it to another investment. It makes the most sense to put it into another annuity, either a fixed rate contract or an index contract. And I gave him both options. He didn't do either one, but this is one where he probably should have, if that was his concern. He decided that his concern, I guess he wasn't as concerned about it as he thought he was. Okay. I'm not saying he did the wrong thing, but it didn't appeal to him. And he thought, I don't want to enter a new contract. I guess I'll just let it ride. It's just a piece of what I got. A very well off guy. But in that situation, when you want to protect the balance of the contract and decrease risk across your entire portfolio, that would be the time when you look at moving to a different contract. So of the 3 in this example, there was one person I thought should do something different or move to a new contract if that's what he wanted, right? Now, I've probably had 30 or 40 of these questions over the past couple of years. Variable annuities have become really popular every time there's volatility in the market because the investment managers are trying to hedge the risk in a portfolio, but keep assets under management. They're going to sell you a variable annuity. That's how it works. Okay. So, but out of 30 or 40 people in the last a few years, I probably recommended a change. I did sell one annuity to another person that was in the similar situation as case study 3. He's happy with it. He got to lock in his account balance and he's got no fees now on an index annuity, and it's great, right? So fee reduction, all that stuff. But out of 30 or 40 people, there might have been 2 or 3 or 4, maybe it's 10% or less of those people I said, yeah, you should make a move. You should do something different. The rest of them, most of them, I told, yeah, you know what? As long as you understand the contract, hang on to it, and that's what you should do. But these guys all had variable annuities. It doesn't make sense for me to sell them one. Less than 10% of the time, I told them they should do something different, and maybe I'd get some business out of it. I didn't win any of these 3, which is fine. I just want to explain myself and talk about how it works and why, if you're in that situation, you might consider asking me about it, because my goal is not just to sell you something. So it comes down to, variable annuities come down to it's fees, market volatility, and personal preference. Okay. Now, I think there's a better way to do a lot of things. And again, it's not necessarily a better way. It's my way. It's how I do things. I'm here to appeal to the people that like the way I do things. And so that's why I explain the alternatives, because I don't want to be seen as the person that only has one way of doing it. I'm going to put this out there for anyone to look at it honestly and say, yeah, I do like that other way. Now, if you do like the other way and you read this and you use this, this website to research variable annuities and you decide you want one, well, heck, the guys I worked with in Missoula, decades of experience, extremely ethical people, really good guys. I can't thank them enough for the things they taught me. And they sell variable annuities all the time. I've had a couple instances where I kicked off some business to them. I don't know where it went, but the only disclaimer is I'm not going to make a commission, but I'll probably get lunch out of the deal. So they're grateful when I send people over to them. So that is possible for anybody who wants to look at all this stuff and say, you know what, I'd really like to take a look at a variable annuity. So, but if you want a low pressure place to look at it and figure it out, educate yourself in Annuity Straight Talk. Go to the newsletter page, search variable annuity. It's easy to do. There's a ton of stuff in there. And actually, I showed you 3 articles, but there's 7 or 8 of them that have been written over the years. Some of them more specific, guaranteed lifetime withdrawal benefits, all that stuff. But anyway, I appreciate you joining me for episode number 42. So schedule a call with me if you want to talk about your options, variable annuities or otherwise. I can speak it. I don't sell them. I don't sell variable annuities, and it's not because I can't. I have been able to in the past, but and if they become a tremendous value and I ever say they're unequivocally the best option that somebody has, I'll go activate my license again. It's no big deal. If I wanted to, I could do it. I'm not going to. That's not my business, and I'm not out here just to sell something to everyone that calls. So sign up on your favorite podcast platform to subscribe, or on YouTube if you want to see the video. You see the screen shares. Get a chance to see me with my my modest Montana background behind me. We get leaves are coming in right now, cherry blossoms. So I might want to do one in the cherry orchard. It's going to be beautiful here in another week. So, but you can schedule a call with me, top right corner of any page on AnnuityStraightTalk.com, or give me a call, 800-438-5121. Now, I get a lot of spam calls, brokers, wholesalers, if I answered everything. So a lot of times if I don't recognize the number, which I won't if you're new, I won't answer the call. Just leave a quick message. I'll usually call you back right away, but I do have to screen a little bit because I am a one-man show. A lot of people are surprised when I answer the phone. Oh, I didn't think you'd answer. Are you the guy from the videos? Yeah, I'm the guy from videos. That's me. So I'm here. Cell phone, 800 number forward to the cell phone. When I get to know you, you get the cell phone number so you can text me. But for now, keep it simple. Give me a ring or set up an appointment if you want to chat. Episode 42, AnnuityStraightTalk.com, why I don't sell variable annuities. Thank you so much for your time. I look forward to seeing you next week. Have a great day. Okay, bye.
You have been listening to Annuity Straight Talk. The preceding information is for informational and educational purposes only and does not represent tax, legal, or investment advice. The views expressed by guests on this program are their own and do not necessarily reflect the views of Annuity Straight Talk or its partners. No information presented today should be acted upon without meeting with a qualified and licensed professional. It is important that you read all insurance contract disclosures carefully before making a purchase decision. Guarantees are based on the financial strength and claims paying ability of the insurance company.